It used to be that you would come in and you develop a new strategy, say a short-term strategy, and you'd say, well, that's not overlapping completely other strategies. We'll put that in the portfolio. But that's not how it works. It's almost as if the strategy development has become secondary to finding ways and times, not just time of day, but conditions in the market that are better for us than others.
Traders, I just finished up recording the bonus section with Toby Crabel, available to members, and it was a lot of fun. We pulled up charts together for like 45 minutes for fun. He pulled up charts from the 1929-1930 Great Depression. We were looking at price and volume, his approach to the markets that he calls effort versus result, which is framing from the great Wyckoff. And this is all about how much energy the market is putting into a price move and whether that is being effectual or not. And if a lot of energy is coming in and it's just dissipating, that tells you one thing about the market. If a lot of energy is coming in and the moves are following through, it tells you something else. So very interesting stuff when you look at the markets with that trader, even discretionary mindset, and then start thinking about, well, how can I systematize? How can I get quantitative about this kind of thing? I think this is the future of trading. I loved it. This is the kind of stuff that the bonus content that members get access to. So please check that out on algoadvantage.io/collective. Join the membership. Of course, if you are an annual member at the moment, you now get access to my AI course that I've just released, which as I was just speaking to Toby, like AI is really transforming their whole stack, being implemented, across their platforms. Every serious trader is using it. Still a lot of traders are not using it right, genuinely. So there really is only one way to use AI properly in trading. You have to be very careful about it. But if you are not, if you're trying to do serious quant research these days without something like Claude Code and this specific setup, then, well, you're giving up a lot, right? You're giving up throughput. I mean, one properly specified overnight session now does what used to take me a week. Your breadth of testing compounds. You've got more universes, more variations, more robustness checks per idea because the marginal cost of the next test has collapsed. So you're giving up the referee's discipline. And this is where there is only one way, a very specific way that you need AI set up for trading research. And I call it the closed loop. And that means that the AI is the conductor only, and it simply manages your data and your backtester. You set up Python and it analyzes the results produced by the determinate backtester, not by an indeterminate AI black box. And without that closed loop, well, the AI sort of becomes both author and judge of your own backtests, and that's not really a good research workflow. That's just a conflict of interest. You're also giving up the compounding memory, right, of your work. Without the error logs and the notes that are being accumulated, then every session you start just starts amnesiac. You're giving up guardrails where unconstrained AI is a very fast overfitting engine. We know that. The optimizing rules that I'd provide, the significance flaws, the survivorship-free bias conventions, these are the difference between research and messing about with the new toy. You're also giving up the coach. So you've got now a coach on hand that you can ask every syntax question, every why did it do that, every explain this script line by line. That's all answered instantly now, and it can cite the actual reference documentation. So you don't need to post questions on a forum and wait 3 days for an answer, and you really can get a lot smarter, a lot quicker in the process, but you need to know the answers that it's giving you are well sourced. You're also giving up the archive, right? So every study, pass or fail in my stack, it files a brief. So your market understanding compounds, either way, pass or fail. Without it, your failed research just evaporates and you learn nothing twice. With it, you're building up an archive of serious research. And that's really what it's all about. So you combine all of this, and this isn't AI replacing your judgment. It's AI doing more than you ever could do alone in a structure that stops it from thinking for you. So you've got a PhD quant intern on staff, you need to be using it. Check it out at algoadvantage.io, again in the Academy section. Thanks for subscribing. I appreciate it. Please comment below with any questions. I love hearing from the Algo Collective audience. Thanks for all your support, and let's get on with the show.
In a trading world full of hype and shortcuts, we separate the signal from the noise with serious conversations, rigorous analysis, and proven ideas from people who have actually done the work. Delve into our deep research on Substack with courses, community, extended interviews, and more on our website, algoadvantage.io.
Toby Crabel, it is a real pleasure to have you on the show, mate. I mean, Jack Schwager called you one of the best CTAs in the world. Crabel Capital Management now has over $5 billion under management. Of course, you close to $5 billion. You've authored the book Day Trading with Short-Term Price Patterns and Intraday Breakouts in 1990, which I believe when I just looked on Amazon, it was now priced at like $1,483 or something. So probably outperforming many of the funds that you compete with, that book. So it's going to be a fantastic chat. I want to get into some of that background, and you've been in the industry so long. I'm very curious where you picked up some of those early ideas from, especially those in the book. Of course, you made famous the opening range breakout trade, the narrow range NR4, NR7. I've heard it as. I don't know if there's an original. But Toby, if you could, tell me a little bit about those early days and getting started and writing that book.
Well, I had an interest in the late 60s, early 70s. Grandma gave me 32 shares of Eastman Kodak, and I found a way to sell it at the low of the 73, 74 bear market stock market break.
Mm-hmm.
And then started trading minimally, but watching markets. And, I was interested in college. I looked at gold. Gold was at the time, it was $35 an ounce pegged. And then they went off the gold peg, and it became a volatile, very interesting tradable instrument. And so I watched that through. I used to trade options on homestake mining and ASA, which another name. They didn't really. I don't even know if they had futures. I think they probably did, but they were arcane, a little bit more difficult for somebody who wasn't around the commodity exchanges yet. So I used options on those gold stocks and did okay. I think I used my scholarship money, and I found ways of getting capital through student loans and grants, and I was pretty resourceful in that respect, and I would use that for investment too. And it helped. It was an interesting period. What was based almost exclusively on technical analysis. Maybe I had some ideas, but it was usually chart based ideas. And later on, I was aspiring to become a professional tennis player, and I played in a Division II school, and while I majored in finance. I didn't finish university. I went on the circuit beforehand. There was a summer when I taught tennis several years before I went on the circuit, and I met a cattle trader at the Mercantile Exchange who I gave tennis lessons to, and we talked about his business. And he invited me down to the exchange. I saw the floors. And after I was done playing tennis, I didn't do much during my tennis career in the way of investing, but when I had time off, I would go to the exchange and visit Tim. He owned a brokerage firm with the chairman of the exchange there, also Jack Sanders. And he he showed me around, and then I ended up, when I stopped playing tennis, going down to the floor as a runner at actually quite a pay cut, because I was making reasonable income from the tennis, enough to at least pay my way, and I had a few bucks in the bank at that time. The currency was a different value, so. But I stuck with it. I really didn't go back to tennis once I started at the exchange. That was 1980, and gold was topping when I came to the exchange at around 850, which was, it was an incredible market. And so then quickly, the first thing I studied, and I actually was a strategies by Gann. And he was a very esoteric sort of technical analyst. He did some very good technical work, but he also had some very interesting mystical aspects to his work. Mm-hmm. So, but I was paid to. Sorry.
Oh, I've got those original Gann books behind me. I dare say I never really got into them, but they had the clear sleeves that you could lay one over the other and all sorts of things that you could line up.
Well, yeah, and it's a lot of that didn't really suit me either. So, but what I did get from it was some pretty original and good ideas around technical analysis and graphic displays of data. And after that, I took a course with a guy that was around the exchange, and he taught Wyckoff principles, and that was very helpful also.
Was that Monroe Trout?
No, it was
before then.
A fellow named Nick Flambourse. I met Monroe, heard about him in the late 80s. He bought my book that you mentioned, and I went to visit him. He had moved to Chicago from Connecticut, I believe, and he wanted to be closer to the exchanges, the futures exchanges, because that was a big part of his business. So I went over there, and we sat down for a couple hours, and we talked about who he had worked for and his observations. He was it was an interesting conversation because he had my book and he was taking notes while we talked about the book. And he said, look, I've looked at what you're doing and I was able to verify your ideas, your concepts. So apparently it helped him with his business, but he was very good. He was at the sort of the top of the top of the heap in the hedge fund, or certainly in the CTA world.
So you'd already written the book, Toby. You'd already written the book. Like, what prompted you to write the book?
Well, from 1980 to 1990, I developed a advisory service to floor traders. And we had about 50 floor traders buying a daily commentary letter. And I covered 20 markets around Chicago. And then we did do some work with the mercantile exchange in New York too. So, and that was a pretty good business, but it was also very demanding and required that I really pay attention to markets and give good ideas to floor traders who were scalping. So it was very short term. And I also traded for Tim Brennan, who the man who brought me, gave me a job on the exchange. And he had he owned part of the brokerage firm. They had no commissions. So I was doing very short-term trading. And, and that's unique because, if you're outside the exchange, back then commissions were as high as $80 a round turn, and it was prohibitive for short-term trading. I had a zero commission. So I was day trading from day one, working with Tim. So there was a fellow that we ran into, kind of a story behind it, but he wasn't really an analyst, but he had this idea about a move off the open and what that would in the bond pit, and he had a fixed number, eight ticks above or below, you go with it every day. So we looked at that, and it started me thinking about the idea of momentum off the open. There was another fellow named Earl Hattaday who wrote a book called Opening Price Statistical Data, and he also ferreted out in his research that when the market started moving, the tendency was for it to go in the direction of the movement rather than back to the open. The open was a very sort of precise area of energy because there was no overnight sessions. Everything was right at the open everywhere around the world, and so what you really had was a focal point to start the day, and that was the reference point for most traders on the floor, for sure. So I incorporated that into the newsletter that I used, but also started doing research on that. And the research started to look very interesting, and that was, say, 86, 87. And I just thought, well, here I am publishing every day a market letter. Why don't I write a book? And the book was really basically different articles that I wrote for subscribers to a monthly market letter that I did. So it sort of formed itself. I organized it and tried to put it into a good book form. And, it was of great interest. It did a lot for me. It was sort of my calling card in the industry. So.
Yeah. Did it help to formalize your thoughts, forcing yourself to put them into a book? Did that help crystallize things for yourself?
Yeah. And it was a strategy that I used, and was able. And the more I looked at it, I think I realized how important it really was. Now, there's also a conversation about this sort of dissipation of its worth over the years. Yeah. When I went to Victor Niederhoffer's and worked for him in 1991, it was still an important piece of information for the market. Even though there were night sessions starting in some of the pits, the bond pit at the Board of Trade and some others, and you could see some sort of deterioration in the bond markets around the open. But other markets that still had a clean open without overnight trade held up. And going into 1995, 1996, as I'd left Victor's and started trading more client capital, it was a really excellent period for that strategy. Luckily. So it sort of launched the program. We had an 18-month period of no losing months from late 95 through 96 and into 97. So it was quite a period. And that is the best period that I've seen, probably, other than maybe the 1970s.
Yeah. Well, I want to get into later, Toby, the relevance today of all of these ideas and, how you are trading today, how that's changed. But just quickly to round out this introductory phase, tell me a little more about, Monroe, Trout and Victor Niederhoffer and, some of these other guys that you interacted with early on and, what that interaction meant, what you learnt.
Well, again, the book was... I was able to get from the small publisher, the Traders Press, a fellow named Ed Dobson, who ran it, gave me the list of people who bought the book. So it was a sort of a cozy relationship. And so I called them, people. Monroe was one of them, Victor Niederhoffer, the company, Victor Niederhoffer, and Louis Bacon, Paul Jones. So I called them all. And
nice.
So Monroe is easy. I just walked over to see him. In 89, Paul Jones subscribed to the monthly letter that I did and also, bought 2 books or something like that. And we had a conversation a couple times on the phone. And he gave me an account to trade at the time, which was, a reasonably good size. It was $25,000. I was excited, So he had a program where he was farming out his own money to traders that he thought had some promise. Victor, I called after meeting Monroe. Monroe told me that he had worked for Victor. That's where he started, out of Harvard. Victor went to Harvard also. Now his partner, Monroe's, which at that time, I'm not sure he was still with him, but it was a fellow named Steve Wisdom. And Steve now works for Crabel Capital. He's one of the partners at the firm. So there were four or five partners at Trout, the main partner, and his brother, and Steve. And Steve left and went back to Victor's. Both Monroe and Steve left Victor's and started the Trout trading. And they were spectacular. They basically took a lot of the concepts that they learned at Victor's and put together a tremendous trading strategy. And they were noted for having a really solid execution desk, 15 traders that would do the execution for him. So they were very, very, they were savvy with the orders. The conversation was instructive, wonderful, and appreciated that I had with Monroe. I talked to him about going and working for Victor. I think I did maybe have a conversation with Victor before I met Monroe. And I went out and visited Victor, and he was very fascinating, brilliant man, and he put me up in his home for 4 or 5 days. We spent time together, and cool. He gave me $22,000 a year to start working for him in 1991. I took the job.
Did he give you much? Was it a bit of a turtle trader environment? Did he try and train you up in his way, or did he say, "Look, I like what you're doing, just do it"?
No, he had to. He would call it. He had to straighten me out.
Yeah,
right. And really what happened when I saw his database, which I thought was probably one of the best intraday databases I've ever seen, and very, very fast in the research because of the way he constructed it. That was powerful. And Steve Wisdom, who was at the firm at that time, after coming back from Monroe, helped me program. I've always had programmers starting back in 81 and 82. So, so Steve at Victor's helped me put together my ideas. And on that database, it really showed up brighter than anywhere else I had seen. I was using tick data that I had to, structure, and I don't know. I think their database was so clean, and it also led you in a direction that was relatively short term. There was no idea about taking a trade longer than 2 days. It just didn't happen. The database led you to in the trade today, out tomorrow, and with a discrete opening of markets without overnight trading, there was an edge there.
Mainly U.S. markets focused at that time?
There were 5 or 6 markets that were primary, and yes, exactly. There weren't as much in the way the boons, I think, may have been starting in the late 80s, but he didn't really think about that. That really wasn't so much of a thing. I mean, he had, U.S. markets primarily. Now, when I started and left there a couple years later, I did started to pick up all the foreign markets.
It sounds like Victor was happy to cycle through strategies or model ideas pretty quickly.
Well, the research platform that existed there was really fast and efficient and clean. There were no errors really in the database, which was really a problem back then, and still difficult to get through. So I had some answers to that later on, but he had a clean database. It's very important.
So, Toby, I mean, just to touch on something that you and I chatted about last time, with all of this history in the game now, and as we said now, with close to 5 billion under management, there's a lot of lessons learned along the way. And we were talking about newer traders, younger traders in particular, and what a disaster it could be if they don't study history. If you and I were to consider approaching the markets without having thought of the 87 crash or any other huge event, it'd be catastrophic. Like it's forefront in our minds. We've lived through those. I mean, I personally didn't live through 87, but working at the futures exchange, still, it was drilled into me. Yeah, tell me a bit about, what the worry is if newer traders aren't thinking about history and some of the catastrophes of the markets in history.
Well, Harry Kaufman would call them shocks, right? Price shocks. They are, and if you're not studying price shocks, then you have a hole in your systems. You have to be able to survive those. So I mean, so if you have a good database, if you're technologically sound, you're probably going to have a very good database. Now, I used to have intraday data back through 87. It's needed. You need to be able to test through that. If there's no recognition of it, we have other examples, but I have to say that particular 5 or 6 day period was something that I've never experienced since. Maybe COVID. I think COVID probably was pretty close. But the thing about it is we didn't know why that happened. It was very, very difficult on an economic level to pin on that what was really going on fundamentally. So that said, price action has been in our firm the ruling factor for devising trades and strategies. And to me, it goes without saying, even by the way, on the ORB, now I've gone back to 1923, but data's not as good back then, so you have to make some assumptions, but still worthwhile. And I think it's important. History it's actually fascinating to look at the 20s and 30s and the 80s and the 70s. And for every decade has its thing, and I think it's really, really important. I've looked at ORB. And one of the things I'll be writing about is what does ORB look like over 100 years? And there's some very interesting periods with that, in particular the 70s. Now, one could talk about now, are we in the 70s-like environment? Yeah, we kind of are, but there's some differences that make it different. I think that you're not getting the same momentum follow through that you had then, for a lot of reasons, because I think there's huge institutional play in the markets right now. You can look at options, the daily option volume is just, is unbelievable. It's like nothing you could have imagined 20 years ago. And I think it has an effect on the actual underlying price movement. So that's a thing unto itself. But I think you have to, you want to know, like, for instance, ORB, I saw the first deterioration of ORB in the bond pit when they opened up a 3-hour night trading on the floor. It was called Project A. And it dampened the follow through from close of regular session to open of the next day, because somebody, they had an outlet. So a liquid outlet to take profits if something happened aftermarket, there was 3 hours that things could happen, and it started the ORB, and the close to open movements were stunted in the 30-year bond after that. So for me, that would have been a problem. But floor traders, I don't know if they really cared. They just look for liquidity and opportunity to trade. So
yeah, well, I want to get into that. Obviously, the markets have become increasingly 24-hour and global, and so open in one country is different to open in another, and 24-hour markets are upon us in equities, certainly in crypto, close in futures. But just on the history thing and learning from history, it makes me want to ask, there's some qualitative factors there, isn't there, in pulling all of this together as a systematic trader in the way that we think about history and draw from those lessons. And I wonder whether, in a firm like yours where you get to hire PhDs, whether there are, myths that get brought into the business from smart people that may just get them into trouble if they don't have that experience.
Okay, so let's say you're a PhD in physics. We've had a couple, and we have one now that actually is a very good trader. He works with Steve Wisdom, the fellow that worked with Monroe. And so there is certainly the PhDs of the world can certainly be very, very valuable in a firm. Although we've had, I don't know, I'd say 20% of the PhDs we've hired have panned out as good researchers and sort of market idea people. So it's a different area. You could even think maybe a PhD in finance who understands all the different theories about the efficient market and the portfolio management. Maybe that would be helpful, but these are really basic things for us to tackle, and there's really, unfortunately, nothing. We have to deal with it ourselves because of our sort of unique time frames and the amount of strategies that we have. And that complexity requires that somebody knows the portfolio like the back of his hand, and takes all of those things into account, the context of what we're doing. To just hire a PhD who's very, very bright or brilliant, they have to learn the ropes still. It's just like anyone else. And I mean, they may, of course, be more diligent and perceptive and disciplined around research work, but that may or may not be enough for our business. Well, I think as a whole, the firm is a group of well-educated people, but generally speaking, they're people that really love markets too, in addition. So therefore, they'll do the work that the sort of nitty-gritty that's required for, especially our time frame, but I think systematic trading in particular.
Well, this plays into the question around your professional athletic career as well. I know back in the day when I was more discretionary focused, there was a big emphasis or a big interest in the professional athletes who would come into trading and bring the right mindset, or the never quit, never die, or whatever mindset it might be. Do you think that has played a valuable role for yourself as well?
Well, it's kept me in the business, and I've luckily, or I guess because of it, I've been able to make a living at a business I love. There's a great book out by a guy named Thomas Hogarth. It's called The Best Loser Wins. One of the things I don't do very well is lose. Therefore, sometimes I get a little stubborn on personal trading or something like that, and that won't be a good thing. You got to be able. And one of the things about the systematic approach is that you can put all of those safeguards into the systems, and you can also find ways of dealing with in an overarching way the portfolio that you have. If you have a lot of, so we trade 300 markets with, I don't know, 100 basic ideas that are executed and traded in different ways also. So it creates a lot of complexity. Now the question is, how do you manage that? You've got to have ways of saying, no, the trade's not working. There has to be a threshold that you use that gets you out just to stay safe. And that's, what is that coming from? The fear of an 87, the being long in COVID, I don't know, some whipsaws that take place during the day. Are there ways of managing that? Yeah, there are. So at 71 years old, my energy level is not what it used to be. Maybe it gets better. It could be circumstantial. But I went out and played a tennis tournament last week and played the 65 and over division. I won the tournament. I'm still playing in senior divisions. And unfortunately, I haven't been able to play for 4 or 5 days because I'm so sore.
Yeah.
And how does that affect work? When I'm watching markets and trying to theorize about strategies and development, do I have the same energy? Intellectually, yeah, I kind of do. And I think the transfer as you get a little older is that you use that sort of concentration that you would have had on in a tennis match, which can last sometimes 2.5, 3.5 hours. With some breaks, you can manage concentration on the markets. And while that's going on, I draw ideas from that, and that's the original source of many of the strategies that are in the portfolio. Now, we've had a lot of researchers since then, and so there's been tremendous development beyond my core ideas. So at this point, the portfolio is, you'd have to know it very well to recognize my contributions in there. And so it's good to have good people working for you to develop and continue the sort of along the same lines.
But look, you've said that, markets are different but the same. And so, bringing us up to speed through all of this, like, how have things developed? So you've talked about now trading 300 markets, under 100 ideas, which probably break down into 500 individual strategies or alphas, and that managing the complexity there is really part of the edge. So, before we just get into like, well, what are you doing today? How has that transformation happened? What's changed in the markets? What's forced you to change? Obviously, managing a lot more money changes everything because you've got to execute entirely differently and think differently at that level of AUM. But just in the sense with the markets, opening times and so on, like, what's changed that's forced you to change, and what's stayed the same?
Well, there's the external and the internal, and I think the external is the 24-hour trade now, and what to do with that. It's changed the idea of trying to mark reference points. And one of the things I think about, I was first quite idealistic, and I say, well, all markets are this. You treat all markets the same. Like as if they're, one strategy would be put upon every other market. And I now believe that you can do both. You can use a single sort of generalized strategy for all markets, and you would also want to look at particular issues in each market, which takes a lot of time. So, if you look at the day the U.S. You have the silver market and gold market opening at 7 or 8. New York 825 and 830 for gold, and there's some relationship to those markets to, say, the stock markets in the U.S. also, but the timing in a market. One thing that's, I think, very, very important is time of day, and each market seems to have their own characteristics. So because of their opening and closing times and because of the participants and what they're trying to do, maybe the cash markets that are underneath, these things require that you also think about those markets in very particular ways. So you can use general approaches and you can use very particular approaches to markets. So Hang Seng is a great example. They have a pre-open 15 minutes ahead of time. They, by the way, have a pretty clean open in a way when Shanghai or the Chinese mainland markets start 15 minutes after their pre-open. And several of the Asian markets have similar things where the volume really comes in a little bit after the start of trade. I find the Asian markets to be probably more akin to what we used to see back in the 90s with the momentum. I think it's very good. They're very good markets, especially now with their volatility. But the 24-hour trading has changed everything. We had primarily back in the early 90s, I used ORB as a primary, or previous day's high or low as a reference point for marking and entering trades. Now we probably have 10 or 15 or maybe even 20 different reference points that exist in any market and different ways of navigating that. So it's been very, very important to add and understand that. And by the way, things have changed. So ORB is not as important as some other stuff that is also a reference point. It's equivalent or better than opening range breakout because of the obscurity of some of the opens. The closing of the previous day tends to be much more important now than it ever was, I think. So those are important. The other thing that, especially with the option trade as big as they are, there's an awful lot of standing in front of moves above and below 1 or 2 day highs and lows. And you can see markets stop there. And I think it has a lot to do with there's a lot more mean reversion. Now, when I say a lot more, it doesn't take a huge percentage to change the dynamic that you're working with. If in the past, 56% of the time the market would continue going up if it took out a previous day's high, and now it's only 52 or 51% or even less, which I think it is. You have a huge difference in the end results of the trading. I was listening to Federer at a commencement speech. He said something about his career in tennis, and there's some similarities. Crabel Capital tends to make money 54% of the days, 53% of the days, which is interesting. And Federer said that he won 80% of his matches in his career, but when you count the points, he won 54% of the points total of all matches, which is a fascinating statistic. So what does that mean? That means, well, you got to forget your losses quick and go on to the next point because you're going to lose a lot of points. Now, at the end of the day, he's winning a lot of matches and he's an incredible champion. 80% is a tremendous statistic. I don't know if that relates, but what it's to what I said about Crabel Capital's returns. I mean, there are some high frequency firms that make money 80, 85, 90% of the time of the days. So I think. So that isn't what we are. We're more of an alpha driven firm. So it's a little different, but it's an interesting way in understanding about the markets and what makes money. It is a bit persistence and doing things over and over again and not worrying too much about those unless the drawdowns become too big. You just keep doing the work.
Philosophically, Toby, I guess that sounds like something that hasn't changed over the years, like the approach, that discipline, the just stepping up to the plate day in, day out. Those kind of principles have, I guess, remained over time. But let's talk about what you're doing now then.
Sure.
And jump into how you're actually trading, what the current book looks like. It sounds like one of the big transformations has been to take on global markets, hundreds of markets. And I like the idea of that diversification. I like the idea that you mentioned of having these kind of archetypes or buckets, principles, strategy types, whether it's one thing or another. You tell me, more momentum-based, more mean reversion-based, and then having this ensemble or multi-model approach under that. So it sounds like you've got a lot of things firing. And just to give everyone the context, bring them up to speed, because we probably didn't mention this, and if they don't know you, you're obviously a short-term trader still to this day, which really makes Crabel quite unique, because to be managing that amount of money on short-term strategies and not be a market maker is, something quite different. So I want to get into that next in terms of how you manage that capacity, because obviously there's a lot of expenditure on the tech and the capacity to manage that AUM. But yeah, so what does the book look like today at a high level in terms of strategies, diversification, that multi-market and multi-model approach, and the different strategy types?
The original portfolio construction was to try to have start with mean reversion and momentum in equal size, and they tended to be non-overlapping. So that was important. Now, things have developed over time, and I don't know if we're 50-50 right now, but it's still a big factor. It may be 60-40, 65-35. I think it's dependent on the way the markets are operating too. So that is a factor. But we like that type of non-overlapping sort of environmental approach to the markets. So there are, I don't know, let's call it 10 or 15 different buckets of strategies, types of strategies. And some of them are very easy. It's momentum and mean reversion. There's sort of a time frame element to that too, that we want to. If something's 3 days, that's quite different than something that's 3 hours. So we'll put in short-term momentum versus short-term or longer-term momentum in our short-term portfolio. So we first categorize the systems into those sleeves. From there, we go to our markets, and of course, we have to consider liquidity in markets and what we think we can do there. And so we have a division of regular markets. When we first started, I had 20 markets or so U.S. So now we have 300, including mainland China and elsewhere, and South America. So we have all these markets, and then there's a high liquidity bucket, and there's a low liquidity markets that may not be able to trade the shorter term strategies as well as a market like S&P or NASDAQ. So that could be, I don't know, Azuki beans or something. I don't know if they exist anymore, but something along those lines where there's not a lot of volume. And so we parse those two into separate portfolios and then treat them differently with the holding period. So as far as managing that, so we have overlays on the portfolios to reduce risk if we get too many light trades in light markets. We want to trade, say, all the interest rate markets, all the stock markets. But we also have other ways of looking at, returns that are worthwhile to chase. And we keep a very close look on how things are performing and how strategies are performing. And we have mechanisms to cut back on different strategies if they're, for some reason, not looking as good as they were before. And then sometimes markets just aren't quite as hot. For instance, when cocoa was trading, was having such huge rallies and breaks, that became one of the best markets in our portfolio, and it had never made any money, prior to that huge bull and huge bear move. So, interestingly enough, that kind of reminds me of 1970s stuff. But that's just my sort of look back. Things like that are happening more. I think there's markets that are doing things that we haven't seen in years. So actually, I think I would expect that to continue, and I'm guessing through the 20s here, up until 2030 somewhere, because I think there's just an environment here that's not dissimilar totally from what went on back in those days. So there's been tremendous work done on execution in order to take care of a faster trading approach like ours. Now, you're right about this. I mean, we aren't a high frequency firm. We do look at things that are of interest probably to also high frequency firms, especially for our execution. But we don't trade that way because there's just not enough there for us to do that. But we do trade sub 1 hour on some things, and we do trade up to 2 days on our basic short-term products. And there's a large span of holding periods, which also allows us to diversify and not crowd in on our execution moments. So that also helps considerably. And that wasn't the case 20, 25 years ago, or 10 or 15 for that matter. The kind of work that's been done at the firm has really looked at where we have some sore spots in trading this way, and try how to remedy that. By the way, this leads into hire really good active minds and have them, engaged in the process. Whatever it may be, partnerships, bonuses, and your chances of being successful and better development are it's much higher probability, and that's I've leaned on that over the years.
Yeah, I think all good managers have. Well, this speaks to trading as a business too.
Yeah,
even for a solo trader, be they retail or very advanced or however you want to categorize yourself. I know it's certainly a big theme for me that trading is a business, and it certainly takes something of an entrepreneurial mind and a broader mind, a bit of a breadth in experience base, because there's a few different, very diverse skills that need to come together to make it all work.
Yeah, that's right.
You have to be technical, but as we've talked about, having an understanding of history, knowing what to even test and what is relevant. The data's not necessarily going to tell you where to focus your attention. So there are a lot of factors into it. I just want to ask about the thing you just mentioned before around trades or strategies built for a single market versus a strategy that can be traded on any market. So, and I think it makes sense at the time frame that you're trading that models have to be tweaked for an individual market. But I guess what more could you tell me there? I guess you've got that archetype, but you're willing to do, a fair bit of tweaking per market to make things run on individual markets with individual flavors?
Yeah, yeah, absolutely. I'm going to say this: time of day is a factor. What's going on in a day, if it can click into whatever our strategy is important. I remember when I went to Victor's in the early 90s, there were books of prices that were kept there, and Monroe's trading was in the book. Basically, his you could see his P&L, and the word around the shop was that there was a certain moment that that Monroe would always trade, and he was trading a lot of momentum. Okay, so great, and Victor always thought that was going to eventually stop working. And it, in effect, that basic strategy that he developed, I can't share the details because I respect Monroe, and he's been a very generous person to me and over my career. So, but the idea that he had was pretty general and applied a lot, pretty much the same to each market. That doesn't really work as well by a long shot to what it was doing in the late 80s and early 90s. And in fact, his track record, I think, didn't really generate much profit later on from that area. He went into mutual fund timing and other sort of arbitrage work. And at this point, I'm sure that portfolio has no look at all as to what it was like back in the 90s for him. I mean, he has other people running that firm now. I don't think his name is even on it anymore. But the thing is, you have to be flexible enough to realize that things are always evolving in markets. They're not eye-popping on any given day necessarily, but they are glacial moves in our sort of our lifetimes that are important to consider.
So are you assuming that strategies built these days could get swapped out reasonably quickly, or the intention still is to build things that have staying power because the glacial moves are slow enough that core principles like trend following and momentum and so on should remain?
Well, I think trend following has a certain characteristic. I think it's been better than it has been in a while. But I think the short-term trading, you can only go so far out of the box, and you can either go against price movement or you can go with it, I suppose. But the devil's in the details. So how do you take profits? Do you take profits? Do you use time as your exit, or do you use levels, or you have to ask all those questions, I think, and they are something that you can incorporate into the systems if you find edge there. Is a market that's just sitting there better to trade in than a market that's running? Do you chase markets? Do you have to execute your trades when they come in at a certain time, or do you use time? Yes, you do, I suppose, but you also don't use time. So there's a lot of different ways to do it. And what we hope is that we have a strong enough sense of and spread of strategies so that we're able to cover some of the evolution of price movement. But even in a 24-hour market, by the way, Bitcoin is trading on the weekends now on the exchange. I don't know if you knew that. I saw it this last week.
That. No, well, about time. Okay, well, that makes sense.
Yes, so we're 24/7 now, and the fact is that momentum and mean reversion are sort of the two cornerstones of our portfolio. We're not an arbitrage shop. We're not a spread shop. We're strictly alpha based.
And are you an alternative data shop, or is still mostly price-based data? Whether you're using satellite images or social media feeds or something other?
No, we don't. We're price driven. I suppose you could say we're to some extent volume driven. I think a lot of my newer work is incorporating volume and price. When you look at a vertical bar, you're looking at range size versus amount of volume per range. And an old Wyckoff concept that really hasn't been incorporated on a systematic basis much, because volume just didn't seem very important to the people that had databases. So, and price is, by the way, price is king, and you don't want to, you can't defer to some sort of derivative indicator, because you have to, price is first and foremost. So what do you do with price? If it goes up, you want to sell it or you want to buy it? That's the question. If it goes down, same thing, sell it or buy it, or do nothing. So
just volume, and I know we're going to get into this in the bonus content for members, but volume is something that is, not always easy to incorporate into strategies. And it makes me think of whether you maybe have a preference for when you're looking at a chart. Do you like looking at, say, volume-based charts or tick charts or something other than minute charts and time charts?
Well, I think there's uses for charts other than graphic displays and databases that are other than time-based. I think. But then the question becomes, if you have there's a fellow named Richard Olson in Switzerland that wrote on high frequency data and databases, and he referred to tick databases as intrinsic time data. So it's the market time, right? So a bar is made because of how much activity was there, or how much volume took place in that moment, and then the bar develops. So it's interesting, and I've looked at that, and I think there's definitely applications there. The basic chart, though, is time based, and there's a reason. The one reason for that is that because you have a little bit more control over your database on a time based database. And that's important, I think, and to be able to feel like you have some sort of standard that you're working with.
You can line markets up at least.
And
compare one with the other.
There's that, and I think that's a good example. I think there are things there. There are edges in market comparisons for sure. So, volume is derivative. I think it's really important, but it can be very deceptive too. And of course, on the intraday level, you need to modify it for clearly on time of day, because you have the volume smile that tends to be there from opening to close in most markets. There's the natural lull in the middle of the day or later in the day, and then it perks up near the close. But that has to be taken into account. So you have to compare it to prior days at that time, and then you get sort of a relative look at it. And I think when you're dealing with volume intraday, you certainly have to do that. It's very important. On daily data, you would do anything daily and higher, you would also do it, but it's a little simpler. You probably just, you can use a moving average in the last 10 or 20 days or something like that, and you can look at volume relative to that and range relative to that. And then you've got it's an interesting thing. One of the things that I think that happens is, especially with more mean reversion in the markets right now, is they they tend to have relatively high volume with relatively narrowing ranges at highs and lows sometimes, a lot of the times. Important areas, that become significant. On a daily, you can see a lot of important highs and lows coming with that kind of structure.
Hmm.
And I think it's Wyckoff called it, I don't know, a churning or laboring. He would refer to, effort versus result, and he would say that's big effort with no result. And that's a warning sign. It's just a warning, though. You can't, he was always, I think, very, very astute about, wait for the test, get verification. And then you can enter your trades. There's no reason to stand in front of movements without some verification.
Hmm.
So all of these things, price is the market reality.
Yeah.
That's whereas volume can be very, very obscure sometimes.
Traders, crypto is not a wild, unruly market. It's an asset class with 500% more time for price discovery and opportunity. My new course, Crypto Trader's Edge, is now live through Algo Advantage, one of the top quant pods and academies out there. A full systematic framework, backtesting, strategy development, validation, real edges with full code, not hype. Links in the description, or head to my Substack at Rectelligence. Now back to the show.
Toby, can I just transition into trading at scale? Like, I don't think there's a lot of your competitors trading short term the way you trade at this level of AUM. So, why do you think that is?
Well, I've seen the competitors in the short term arena. A lot of them, many of them. Well, some of them came to our firm after they had large enough drawdown to affect their business plan. So I'm thinking of, well, there's several, but we've either incorporated them or it didn't quite last. So the problem is that I think you feel the evolution of markets, I think, a lot faster in the intraday time frame. What's going on in there is it happens in shorter periods of time. Just adding an hour or two to the bond trade back in '86 had huge ramifications to close to open price movement. That's an effect for a firm like ours. We used to always at least go into the next day if we got a trade today. And now we have liquidity enough at least to try to get out at a decent price, or without slippage. We're stingy, in the 24-hour the off hours of the primary session. So it's a much tougher game. I would have to say that, if you're a trend follower, you've got very basic concepts that you can go by, and you determine what you want in the way of volatility, and you follow a trend. You can think of 100 different ways. You maybe want to use all of them. And I remember David Harding at Winton was using multiple methods to enter his trades, so he wouldn't overlap or have too serious a slippage problem. That strategy is limited to good times when markets are really trading well. So that a shorter term strategy can grab a profit from the intraday volatility, but it may not be going anywhere on a trend basis. So it's appealing. But the problem is, understanding what you're up against and what you're doing. And I've seen many let me give you an example of the largest short-term trader besides, say, Monroe Trout back in the 90s was a firm that was in Chicago. And he had, $300, $400 million. And he did pretty well on a 2-day holding period, maybe 1.5, 2 days. And I was talking to the principal and the owner, and he just raised $300-400 million, and he was going to be the largest short-term trader in the business. Smart guy, nice guy, and I asked him. I said, "Well, what are you going to do? You're getting all that new money?" And he said, "Well, I'm just going to extend my time frame to 4 to 5 days on my momentum trades," because he was primarily momentum. And I said, "Well, if you think about the time frame structure, I don't know how this looks on camera, but if you start here at 1 day and then you move up to 5 days, the wiggle and the vibration out 5 days is much greater volatility.
Right. Yeah.
A lot more risk, and there is no simple way to get around slippage problems by just extending your time. He assumed higher profitability over longer holds. You automatically will get have a problem with this. So he went out of business.
We had a bit of an interruption there, or hopefully this edits back in okay, Toby. But yeah, talking about trading at scale, the effort that you have had to put in as a firm to execute short-term strategies at this scale is something I'm quite interested in. I think it's something the smaller or solo trader maybe doesn't have to think about too much, obviously, and just how much edge there is in that, and just how much investment you need to put into that. I know you've said in the past that when you first started trading, you traded without commissions, and that potentially influenced, how you thought about short-term trading.
We have seats now in our fund, so we are able to get basically he owned the brokerage firm, so they didn't charge him anything. But we have a very, very small charge for our trades. It's microscopic compared to what it used to be. So that's important. Some of the clients even buy seats for their larger managed accounts. That's one thing, but the thing that's really going on is that we deal with every tick, and we deal with the book, and we research that to find better concepts in execution. And that has paid off tremendously, not, in addition to co-locating globally. So our systems are sitting in 5 or 6 different locations around the world on computers next to exchanges. So that speeds things up. I mean, the trip from Los Angeles to Hong Kong is a timely trip, and I think having our systems on computer there, it makes a difference, and it also that spans through Asia. And the best firms do that. The best high frequency firms certainly do it. And if you're short term, you have to consider that for sure. But then there's looking at the data. Are there ways to get a little better edge, a little alpha from each trade based on what you're seeing in the book? And I have to say that yes, we found ways to do that, and it's important because we're one of the largest, futures traders. We trade a lot. The They even gave me an award at the Mercantile Exchange for trading a lot. Well, no, it was a Lifetime Achievement Award for trading lots and lots at the Chicago Mercantile Exchange, including we were members. Now, it may be for different reasons, but I don't know. I mean, I was kind of young when they took me in with a Lifetime Achievement Award. So I appreciate it very much and love the Chicago Mercantile. That's where I kind of grew up in the business and that and the Board of Trade. So great place, incredible development has taken place in there. But we trade so much that we really have to consider what's going on every time we poke at the market. Does everybody do that? Do they put the dollars into it? Do they have the people doing that kind of research? No, not CTAs. So therefore, I think a lot of them then opt for longer holds. That's the natural sort of progression. They want to trade futures. It's an interesting area unto itself, even trend following with futures, because there's so many markets and avenues. But to trade shorter term, is going to be more challenging and expensive.
Yeah, so it's an enormous investment, really, isn't it?
Yeah, it really is. And
so tell me, Toby, more about your process, your research pipeline, start to finish, trying to help the smaller manager, newer trader, thinking about designing that process, that research process, what constitutes things that are statistically significant alphas, what constitutes making a model robust, that you can have some faith in it, and also having a robust portfolio, because as you said, your approach has grown and matured into the need to deploy so many hundreds of systems over these different archetypes, over 300 markets. What's the sort of high level of, thinking about making sure that the portfolio is robust?
We look at our portfolios from last year and the previous, I don't know now, I think we go back 15 or 20 years, and we make changes every year to the portfolio. And one of the things we look at what the 2008 portfolio would be doing now and all others. So that matrix will tell us whether we're making the right kind of progress in our development as we're evolving. This is reality 101, is that certainly our 2005 or 1999 portfolio would not be making money right now. In fact, last year was a tough year for our firm. And but if we went back 3, 4, 5 years, 6 years, it would have been even that much worse. Right now, I have a conclusion that I feel about what's going on with the markets, and that is that there's more size standing in front of moves. So if you look at the price charts, I mean, if you look at moves above and below previous days, highs and lows, there's a lot of mean reversion going on there. There's a lot of people that don't have much in the way of. Those are big reference points and concepts that people are keying in on. There's a fellow that writes about this. He splits up the Asian session and the session in Europe and the U.S. session, and each one of those, the highs and lows, have of interest. They're interesting reference points. He also talks about gaps in the market, moves that are too fast. Will they be seen again? And if they are, what you do? I mean, these are interesting developments that you may or may not have ever thought about 20 years ago.
So it sounds like in your mindset, you're more of have more of a causal or reasoned-based approach to strategy design rather than a machine learning approach, so that something makes sense, you've uncovered something in the research or by staring at charts, by thinking about the participants and who moves when at what times of day, and you're building up things around that, more so, correct me if I'm wrong, more so than maybe letting the data speak or letting the data be mined, and then that drives what you do.
Well, machine learning hasn't been the panacea that we would have certainly would have hoped, but there's a lot to AI. I'll say it has helped with the research considerably. Well, one of the things that's helped with the firm is we actually have less people at the firm as a result of it. We don't need certain areas as much as we used to. But in the research area, we do need minds, asking the questions. And we've developed very different kinds of databases to do that now. It used to be that you would come in and you develop a new strategy, say a short-term strategy, and you'd say, well, that's not overlapping completely other strategies. We'll put that in the portfolio. But that's not how it works. It's almost as if the strategy development has become secondary to finding ways and times, not just time of day, but conditions in the market that are better for us than others. So it's it's almost like an environmental read rather than any particular system now. So if you took two parts of the portfolio, mean reversion and momentum, and a long time ago we did separate those two, and what we tried to find were the environments where momentum worked better and mean reversion was preferable. So, and that was environmental, but that kind of thinking, I think, is much more prevalent in the portfolio now.
So can I clarify, do you tend to think about markets in terms of, or strategies in terms of on and off periods?
Yeah, there is.
Or that all of the models run all of the times and they're waxing and waning, because yes, the mean reversion ones will tend to wane when it's a trend follower's environment and vice versa, or you are sort of more actively making sure that the right models are on for the right period and the right environment.
Well, I think the latter is, and that is that we want to figure out our environments and what and there are. We know we already knew it a long time ago, but we've developed more. There's different types of environments that we look at. There's different ways of parsing this out. And each one is a research project. And we're steadily going through things that can enhance, one or the other type of strategy and a portfolio as a whole. So it's broader, more data intensive stuff now. So, yeah.
And has it just been a slow evolution, the changes in the core strategies, in the thinkings, like each year there's this slow adaptation, or have there been some real inflection points like, holy crap, everything needs to change now?
No, that would be hasty. I think the portfolio is modified at about a 10 to 15% rate per year. So all the stuff that we added from January 1st to the end of the year, it would probably produce a 10% or almost maybe 15% if there were very active changes to what we're doing that we think will be helpful going forward. So we're kind of,
Makes sense. And you mentioned AI. So, where is the current research going? Obviously you're someone who still likes to look at charts yourself, even with everything that AI can do for us. You've obviously still got a very smart research team there, but is there something catching the human eye that the algorithms miss that you like to, bring into the boardroom meetings, or where are you directing the research?
Well, I have a lot of opinions, and I discharge them. We have a weekly research group that gets together on Fridays, and I'll talk it up sometimes. But look, these guys are adept at working on the research, working the problem, more than I ever was. And I've always depended upon programmers and researchers to help me on any idea I had. So, but what they're developing, and with AI, let's say we have less researchers, but much more research going on. And we have less programmers, and we have a lot more programming going on because of AI. And that's been the real bootstrap for us. I think we're much more productive now with many less people. So our cost of doing business is much lower. So that's just an income thing. But now, how good is the research? Well, you get 10 good researchers that are aided by PhD like AI, which is really what it kind of is. They can have 10 working projects going each at any given time, and letting it run and giving us input on what's going on. So this is a very productive moment for our firm. One, in our cost structure, and two, in our research development. I'm kind of a philosopher, so and a theoretician. Yeah. And I like to test things out. I trade to sort of feel the market, and if there's something broader that I think may be of use, I'll bring it to the research group. They can pursue that actively, quickly. And I will say that the things that I bring tend to seem to have some alpha, and still, which is gratifying.
Mm-hmm.
But you lean heavily on the chairman. So I lean heavily on these younger folks that really are going at it, and they're really good at it.
Talking about AI, this I've just put together a whole kind of AI with trading course for my members, and it makes me think of something Michael, your CEO, mentioned about moving the firm away from these kind of siloed portfolio managers that you might see in a lot of the other pods out there, the Millenniums and the 0.72s and whatever. To stop people duplicating work, so that all your guys can see each other's work. I'm sure that's played out well, and I wonder if there's a similar. If you're doing a similar thing on the AI. So I've had a little bit of this conversation online. There's a previous guest, Samir Varma, who's on Substack as well, talked about something similar with the kind of quote unquote skills folder, all the skills that we're teaching our AI that makes it specific to how we use it, whether your whole firm is kind of sharing that skills folder, in a sense, building up the AI capacity in a non-siloed approach. Is there something that along those lines that's taking place?
Yeah, well, I think we've got a much more concentric group now, less people, and they're the best that we have. And they are getting together every day and talking about the direction of each of them. So they're coordinating their efforts. I think siloed researching, letting individual managers come into the firm and give them the money, and there's no reason to do. You don't have to do that. It's okay. It's been a great model because you can get a lot of diversification and a lot of different methods in there, but they're not very friendly. It's hard for us to let a researcher go. If he's good. even if he had a bad day or a bad month, maybe he had children or his wife delivered or something like that. So we don't measure them on their performance. We measure them on their output in the research area. And these people would be managers unto themselves, and they were managers, actually. All of them, most of the researchers were managing portfolios at one point. And now they're generally concentrating on research. So they're well trained. They understand markets. They come up with realistic questions to ask and research. It's not pie in the sky because they have traded their own portfolios. So they're a good group. I'm pretty happy with them and what the research looks like now.
I'm saving the best to last for most of my audience. The solo guys, and they're interested in what of all of this is applicable to me as a smaller trader. If someone is starting out in systematic futures today with a smaller account, I mean, is that something that you would say is even realistic anymore? Like, they can't diversify over 300 markets and 500 strategies, that's for sure. How do they start out?
Well, the thing about it is if you're short term enough and you're able to execute 300 markets means, well, you've got regions, so you can get some real fine diversification if you're like 6 hours less holding periods. There's a lot of movement in markets, and you can do relatively short-term strategies with profit taking and risk management that can be very, very effective. You just have, if you want to make it systematic, what I would do is probably start with one market and have multiple variables around a basic idea. And then work your way out from there, but get strict rules around those. Like, say you want to use a mean reversion strategy. Well, just make sure you're stopping yourself out if it's not working. Decide where it's not working. Decide where the alpha isn't there anymore. I think you have to start right with the basics, and that's you've got a system. Now maybe it's one market, then you can apply it to another market. But I would concentrate on building something with NASDAQ, S&P, or some big stock index or something like that. And I would put strong profit taking, and maybe that's part of it being no profit taking, and use time or something like that. And then always have your stop loss in there, and automate it too, and then start to build out around that. Then you could add 3, 4, or 5 markets and do something similar. Maybe some small adjustments for the time of day structure of that market. But you're starting with $20,000, $30,000, 10, 15,000, whatever it may be, or 100 or $500,000 or $1 million, whatever it is. You've got to have a base to begin with, and a simple alpha can carry the weight. If you think of all of the variations on theme that are possible for that strategy, that would be, I think, the way I would go.
Yeah, I like it. It's what we tend to call the ensemble approach, variations on the theme.
Yeah.
I guess, and this is really the question for the short-term trader that you are too. Like, I think a lot of traders assume that short-term has to be more profitable. There's more compounding. There's the law of large numbers. There's a lot more executions taking place. So the law of large numbers presumably can do its work. There's more room to use leverage. Is it more profitable? And if not, why not?
Well, if there's any discretion in it, I would have to say that what shorter term trading will do will wear you out. And our minds are the ones that are overseeing that, in other words, there's some discretionary elements in it, then you're going to have a tired moment, and that may cost you. So the shorter term you get, the more exponentially, I would have to say, difficult it may be, in a way, because your costs, your commissions, your slippage all become a factor that's huge, and you can't have any slip-ups, and Hogarth talks about this. There are people out there that are profitable 90% of the time, but they still lose money. Why? Because their losses are just that much bigger than their. So let's assume, though, that you have stops and you have systematic elements completely, and you can automate. Now, automation is huge in short-term trading. Otherwise, you won't be able to grow. Right. You have to be able to build out a platform that has some diversifying factors in it. And, by the way, you don't have to trade 300 markets. You can trade 10, 12 markets. You can trade different regions. You could trade 5 or 10 in every region. And if you're automated, you can do all that.
I think we were saying last time how when you're starting off, you should be trading your smallest sizes.
That's Richard Dennis said
Richard Dennis.
He said, when you're beginning, you're trading your smallest, hopefully. Don't trade. You got money, trade small and then work, get it worked out, Money can be dangerous.
Well, let's start to close out, Toby. I appreciate your time, mate. It's been fantastic. I guess I just was thinking of the story you shared last time about, sitting around a group of ORB traders who didn't even know who you were, on a forum or something. Maybe you could tell us a bit about that. But yeah, there's to this day a lot of talk about opening range breakouts, and I guess a lot of people don't know the huge history that stands behind it.
Well, I didn't invent it. I mean, who can I? I'll go.
Well,
like I said, Earl Haddad, his book was written in the early 70s, maybe. But John Hill Sr., whose son worked for us, John Jr., for some time, wonderful people, and John Hill talked about it in his 1970s books. Larry Williams worked around the idea of opening range breakout. In fact, he called me upset that I was publishing things on it, and he said it was his at a seminar. And I said, well, I didn't go to your seminar. He was complaining of plagiarism. Well, your $10,000 seminar wasn't where I went. I just did this myself. So thanks to John Hill, he kind of told Larry to stop it. And Larry's a nice guy, whatever.
Yeah.
But, it had been around. And then you hear it was around the exchanges too. So I learned it, and then I tested it. That maybe there wasn't as much testing back then, but it looked good and was worth writing about. Now I've done an update.
Yeah, go on.
I've done an update, and for God's sake, I mean, the damn thing's had its worst years in the last 3 or 4 or 5 years. So we got to be careful, because the open is not what it used to be, and we all know it. Most of us know it, but there are that trading platform that you were suggesting or saying where they didn't know anything about me that's fine. I don't need to be the ORB guy. I've got a lot of other things I want to write about and talk about.
If you were to rewrite the book today, and I think you're considering writing, what are the big updates? What are some of the themes that are forefront on your mind now?
Well, I would add going back further historically, more markets. I would bring it up to date. I would simplify the patterns to something a little bit broader theoretically, and probably more applicable than and some of those like NR7, things like that, may or may not be quite what they were before either. the idea of contraction expansion is a basic principle that I think is still worthwhile and has validity. How you treat that is another thing, and I would probably talk about that a lot more. I would also then probably add new ways of determining momentum and the reference points for determining momentum. For instance, I think I would talk a little bit about the close of the previous day and other possibilities. But so I would add what I think are more viable ways of dealing with momentum. So it's not so much like opening range breakout. That's when it was sort of like a fusion point, the open. But now, because of that, the way things are spread out now with 24-hour trading, you have many other areas, including the close of the previous day, that's very important as a reference. So I would probably talk about that also. So I think it'd be a nice add.
And of course, you'll be doing that on Substack. Welcome to Substack.
Thank
you. You know your Substack handle off the top of your head? Your
Toby Crabel Substack.
TobyCrabel.substack.com.
Yeah.
If you could go back and do it again, Toby, would you? If you could have been this successful in tennis and take the money off the table, forget the money, would you? Because they're two different things. One's physical, one's mental. Trading versus tennis. Are you happy it turned out on the trading side of the fence?
Yeah, absolutely. First of all, I don't know many tennis players that have done as well financially as I have. That's one. There's a few.
There's a couple.
But the problem with tennis for me at 25 years, I stopped playing professionally because I realized that it was manual labor. And I had dug some ditches in high school, and I realized that I was digging ditches out there, and I didn't want to do it anymore. I wanted to use my mind. I think I would have gone, if I spent another 5 or 10 years, I would have been like many, many tennis players still playing the game. And that's how I would be making a living somehow. And I luckily for me, somewhere in my career, I tried out for a tennis pro job and they wouldn't take me because I was too gaunt and pale because I was never out in the sun. So, I was watching markets all the time.
Thanks so much once again, Toby. It's been a real pleasure and a real honor to have you on the show, and looking forward to some of the bonus content that we've got for the members. You and I are going to chat about this, how you read volume. That's something that's just of interest to you. These Wyckoff concepts of effort versus result, that whole framework, how you apply that to your systematic futures trading. So appreciate that as well. But for now, we'll round it out, and
okay.
People can check out the article that I will put along with this on Substack, and of course link to Toby's Substack. And there's a lot more that comes along with being a subscriber and getting all of that content and being able to connect through to Toby. So I really appreciate that as well. So Toby, thanks so much once again.
Thank you. It was fantastic. I really enjoyed this.
Awesome.
It's easy enough to talk about myself. And markets.
Funny, yes, and markets.